Hi, this is Brian Vendig, President and Chief Investment Officer here at MJP Wealth Advisors. We just finished the month of October in the market with a slightly down month, and I wanted to connect with all of you, especially as we move into this final weekend ahead of the election. A lot of things on investors' minds, and I just thought I'd check in with you again and provide a little bit of a brief overview on where we are thus far. We've seen that we started this week, the last week of October, with about 40% of the companies in the U.S. equity market reporting. 75% of companies heading into this week beat on their margins and their profit expectations. And as the week progressed, we saw some mixed news from different companies, but over the course of the week, actually more positive than negative, with earnings growing about 6% more year over year. I think this is a really important theme because we've seen that participation in earnings again is coming from areas outside of mega cap tech. And again, as I remind all of you within your portfolios, this is why we stay broadly diversified. We're following the trends of AI innovation into the future, which is going to play out over the next 5 to 7 years. But we're also looking for opportunities in the dividend paying stocks and the small cap stocks, which should perform better as time goes on, as the interest rate environment is changing from the Fed. So that's one thing I just want to say is that right now the earnings picture is looking intact, and also the outlook for next year is also rosy as well. So we're very constructive still on the equity markets in light of some of these conflicting variables. We've gotten some numbers as well this week from an economic perspective that's showing that inflation is still in check and also the economy is still healthy. And these are all good news items as we move into next year. Now, to switch gears, actually, on another topic, interest rates. We've seen interest rates actually tick up since the Fed cut interest rates by 0.5% back on September 18th, which I know is a head scratcher for a lot of our investors. This has impacted our bond portfolios in the short term, but we still have positive gains on a year-to-date basis, which I think are going to hold. So why are interest rates going up, even though the market knows that the Fed is going to cut rates over the next 14 months? Well, I'll give you the best way to summarize. First, it's the fact that the economic data that has come out over the last couple of months has shown that the U.S. economy is continuing to grow. Now, granted, that growth is slower quarter over quarter, but we just got estimates of Q3 GDP growth through the end of September, and those estimates came in a little bit higher than expectation. So the consumers are spending, as I said before, the economy is still chugging along. So as you get growth in the economy, because of that, interest rates go up. However, at the same point in time, as we all know, we do have this momentous election next week. And as a consequence, the market is betting sometimes on which candidate they think might win the election in advance. And we know this is a really close race. So even if markets are betting in one direction versus the other, or polling numbers are saying one thing versus the other, I think it's really going to come down to who votes and comes out to vote next week, and those that are all voting early. I voted early today myself. So the expectation is that with candidates coming in with spending objectives that are higher than the current administration, that is also pushing up the concept that yields will be higher because there'll be more fiscal spending coming out of Washington, which will support the economy in the short term. And also our deficits are going to grow. So as a relate, the cost of borrowing goes up. So in the short term, we've seen these rates tick up over the last month or so. I actually see this as an opportunity because I still think, based on the probabilities, that we're going to have a split Congress with really tight majorities. Jerseys might change in the Senate or the House, meaning, right now, Republicans control the House. That might switch to they get Democrats and vice versa in the Senate. But at the end of the day, the majority is extremely thin. So the likelihood of really material new legislation being passed, we still think is quite remote. And at the same point in time, prior legislation that was passed, a likelihood that is going to continue on business as usual. So as a consequence, I think right now, from an asset allocation perspective, as new assets are being deposited into clients' portfolios, we are looking to buy stocks and bonds at this time, but in a gradual manner over the balance of the year. And the last thing I'll just mention is, because the election is around the corner, and as we all know, as I said before, I'll just bring up this again, just a few slides, just from a fun facts perspective. You can see, going back to post-World War II, that if you have a split election, the returns of the stock market is pretty similar between a Democratic president versus a Republican president. And even if you measure this differently, to be fair to both parties, from 1950 to now, the stock market is up about 12% under Democrat leadership versus 7% under Republican. And even when you take a view in another way, when you look at what's going on in the first year of a 4-year presidential term, you also see on average, quite robust returns both from either party. So at the end of the day, what we always have been saying to investors over the last few months is that we care about what's going to happen with the election. We care about the election, I think, more on average than the market. And granted, there's positioning between different sectors. And as I'm saying, there's positioning going on right now in the bond market as yields are slowly, slightly ticking up. But at the end of the day, I think what really matters, as I've said in prior conversations, is coming back to the fundamentals, meaning earnings. And as long as we continue to see these earnings outlooks continuing to grow with inflation in check, and also our outlook in the fact that the economy is still not going to go into a recession in 2025 with growth, but slowing growth, I think this is still a good environment to invest, managing risk, of course, appropriately relative to your objectives, and looking at opportunities as well across all asset classes. So I just want to say thank you all again for all of your trust and support over the years, and especially getting through this year, which had a little bit of volatility here and there, and a lot of topics that weighed on investors' minds. So we're going to stay focused on the material things for you, get you all through the end of this year, past this election, into enjoying the holidays, and then we're going to start formulating thoughts for 2025. So I hope you have a great rest of the fall and into the winter, and we'll definitely provide some updates to you after the election. So thanks so much, and have a great rest of your day.